Welcome to TheoTrade. This is Don Kaufman. November 3rd, 2021, a Wednesday afternoon, just about 16 minutes after the cash close here, with the Fed doing the taper dove dance, if you're unfamiliar with that terminology. Yes, the Fed is going to start to taper some of the asset purchases, but within the language, they went double down dove, which is effectively softened everything to the best extent of their ability. Let's get to how the markets reacted. Is it any surprise? S&Ps, they loved the dove dance. So the SPX throughout the course of the week has been really just grinding very, very mildly higher, both on Monday and Tuesday. Today, about a 30-point move to the upside. The single most important aspect about this trading week from this point forward, and I've made this exact same point, okay, in previous weeks, is we are just shy of the upper edge of the expected move. So the line that's on the top of my screen there, mouse is literally on it. It's 46.69 is the upper edge. And that 46.69 relates again to the SPX. So, well, why is it so important? As I said, I have brought this to many of your attention, okay, in, well, the last couple of weeks. In fact, if you look at the last few weeks, well, literally, we ended up on the edge of the expected move, okay? The week after that, we hit the edge of the expected move. We exceeded it, pulled back towards the edge of the expected move to the end of the week. Last week, we ended what? Within 5 points of the upper edge of the expected move. This week, okay, this is an absolutely pivotal level. Now, just because we are on the edge of the expected move, it doesn't necessarily, okay, denote that we can't crack through it. In effect, what I'm saying, we saw this actually again in previous weeks, we can come up over the edge of the expected move, but to get a good feel for it, all right, a very high probability is skirting the edge of this expected move throughout the, the remainder of the week. Does that mean volatility is effectively dead for the week? Not necessarily so. And part of that has to do with, the rally today, and again, I wouldn't say perplexed by this. I would say much more, just surprised to see where the rally came from, and I'm going to explain exactly why. So here we have the S&Ps that take off to the upside. Nevertheless, it's the Nasdaq that really exploded. And when you take a look at the Nasdaq, and specifically the QQQ, and I apply auto expected moves, the Nasdaq is home. It is at the upper edge of the expected move. So what's the surprise? This is the surprised face. What's the surprise here? Okay, surprise is the bonds. Well, the bonds actually took off a bit to the downside, and that initial kind of knee-jerk reaction of the bonds selling off here took interest rates higher. You would have expected that the financials may have outperformed. But in effect, when you bring up auto expected moves, again, auto expected moves is like the great way to kind of compare, one index product versus the other on like a weekly basis. If you look at the auto expected move in the financials basically are just off the starting of the week. And again, the central line, if we kind of zoom into this really, really tight right now, this central line over here, this is where the week effectively began, and we're, again, just north of that line. So interestingly enough, with the bonds tanking, all right, so bonds tank, take a look at interest rates. So here's the TNX, right? So the bonds tank takes interest rates back higher. And again, you would think that the best of the beneficiaries of higher interest rates, of course, would be the financials, and not necessarily so. This appears, okay, to be in very large part just more of the same. It's a gamma squeeze, and it's so incredibly specific at this point in time that people need, okay, to understand what, again, that gamma squeeze amounts to. And I'm going to explain it in a vastly different means this evening. So if we take a look at Tesla, like, in large part, you really want to know what's moving the marketplace. Sure. Amazon is definitely involved here. You know, Amazon, though, like on a year-to-date basis, has done nothing. It's totally underperforming. Both the QQQ, it's underperforming. Of course, the S&P is definitely underperforming, you know, the Russell. All right. Lo and behold, it's all about Tesla right now, okay, and the explosive move inside of Tesla. So if you kind of missed some of the recent videos we've done about gamma squeeze, okay, the gamma squeeze is in effect, all right, a massive call buying, all right, by predominantly retail clients. You buy a bunch of calls, the market maker sells you those calls, then the market maker has to turn around and hedge by buying stock, in effect forcing the stock upwards. You know, the volume out there today inside of Tesla, though, is not exactly inspiring, but nothing happened in this marketplace until, well, till the Fed came out. I mean, like even Tesla, was up mildly here, but again, Fed announcement, all right, Tesla explodes to the upside. The gamma squeeze gets again persistent. Now, push that aside for just a second. As I said, I want to explain like another way of why you can look at the Nasdaq each and every day and literally you have like one product, okay, that matters at this point. Let's start by looking here on the trade tab of thinkorswim, and you're looking over at like implied volatility. Implied volatility in the short term, okay, is like close to 80%. I'm just going to average it for a second. I'm going to average it to about 80% implied volatility. Now, compare that to something like Apple. So how does it compare to Apple? Well, Apple's volatility right now is about 21% in the shorter term. So, well, where am I going with this? What am I saying in this particular context? We have, again, we have Tesla, with roughly speaking, forget the stock price, okay, 80% vol. Then, okay, we have Apple with roughly, okay, 20% vol. So if you wanted to normalize these to some degree, okay, well, what would you need? You would need basically like 4 apples to equal like Tesla, right? I mean, if you volatility normalized everything. And why does that make any difference right now? Oh, because it has to do with market cap. If we take a look at something like Apple, we open up stock highlights here. Let's just round Apple to about a $2.5 trillion company. But then let's go ahead and bring up Tesla. Okay, Tesla, it's about a $1.2 trillion company. But if you volatility normalize it, you can kind of put that as times 4. Well, so it's 1.2 trillion times 4. So you do some quick and dirty math out there. And again, we're going to go there, right? So 1.2 times 4, okay? You're almost to the equivalency of like a $5 trillion market cap, right? So if you kind of volatility adjusted Tesla, it is literally worth pretty much double, okay, what Apple is in terms of market capitalization. So what would you have to do? You realize you would have to add Microsoft and Apple together to equal right now the full power, okay, of Tesla moving markets. And I think that's kind of a cool way to actually look at, well, why does the Nasdaq keep just, you know, exploding to the upside over here? Because Tesla's caught in just this wicked gamma squeeze. So in effect, you have a marketplace right now with not just mega market caps, okay, just the extreme in terms of market caps. And, you know, even though I came in here and I said, yeah, the Fed does a taper dove dance, there's nothing to talk about on that particular front because it doesn't really mean much. Who cares? Push the Fed aside. This is all about retail trading. This is all about Tesla. This is Tesla, okay, that has, you know, the equivalency of market cap of like Apple plus Microsoft together. That, okay, that is power, people, and that is power to effectively move markets. If you can move Tesla, you're moving the Nasdaq, which, okay, here becomes a little bit of the fear trade, if you will. At this point in time, when you start looking at the Nasdaq, all right, you go out a little bit and you're like, oh, the Nasdaq only has 18% implied volatility. I feel that that is incredibly low relative to the risk, okay, that one individual stock, okay, can move that particular index product. And one of the things that I will be doing, okay, here on TheoTrade in the days to come is to actually explain how we can actually trade, if you will, one product like a Tesla against, all right, an index product, if you will, like the QQQ or the Nasdaq 100. With that, once again, the Fed does their taper dove dance, but it's really Tesla, okay, that explodes to the upside, taking the Nasdaq and the S&Ps along with it. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.